Welcome to the Untold Stories of Real Estate Investing, hosted by Wayne Courageous III, a place where active and passive investors come to hear the good, bad, and ugly of real estate investing. Our guests consist of experienced operators and investors who want others to succeed by sharing their stories. If you're looking to syndicate deals or grow your wealth passively in real estate, you've come to the right show. It's now time to sit back, take mental notes, and enjoy our next episode of the Untold Stories of Real Estate Investing.
Welcome to the Untold Stories of Real Estate Investing. I'm your host, Wayne Courageous. For our next episode, we're excited to have Palmy and Nancy Kitti, aka the Kitti Sisters. The Kitti Sisters are joining me today to discuss their journey with owning 11 apartment projects with over 2,600 doors. As first-generation immigrants, Palmy and Nancy were reliant on one income stream with no safety net, despite owning successful fashion manufacturers. When their largest client announced they were closing all their stores, the income they had worked hard for dried up, pushing them to find a different way to find financial freedom. Welcome to our show, Palmy and Nancy.
Thank you so much, Wayne, for having us. We're so excited to be here.
I'm excited as well. And what an incredible, I was telling you before our show, your website is incredible. Your story is incredible. First generation immigrants to owning over 2,600 doors. I mean, I'm excited to hear your story and all. So let's start with that. What's your story? What's the journey? And then, how'd you get from where you were into real estate?
Yeah. So Palm, do you want to share our backstory?
Yeah. So a little bit about Wayne kind of went into it a little bit. So basically, Nan and I, our parents migrated here from Thailand when we were little. And the whole entire time as we were children, we saw how hard they were working. And we thought we need to pay them back by getting good grades in school, getting educated, and doing well financially. And what we've discovered was we found out, hey, fashion manufacturing was our gig, was our thing, was our jam at the time. What happened was we were so proud that we were able to support our family with one source of income. And that was kind of our pride and joy that we saw our friends side hustling. We're like, we don't need that. We don't need that. And we started dabbling a little bit in real estate by buying single family buy and hold in California, thinking that we're in this California bubble. We had no idea what was happening outside of the state, how successful it was. The problem was all this one source of income that we were relying on had no safety net. And one day in 2017, our biggest client decided to close all their stores. Just like that, overnight, 95% of our income was sapped. And we had no backup plan. And we realized at that time, what we thought was our sense of security was completely an illusion. We were trading time for money, even if it's a lot of money. But when your business have no more demands, you become obsolete overnight.
So we had to act really fast. And that was kind of our turning point. So we immersed ourselves in a whole new world through apartment syndication to free ourselves from the daily grind and to give us stability, reliability, and scalability in our next venture.
Yeah. So that's a little bit of how we were somewhat forced to act. And this is what we came up with.
Yeah, that's incredible. So, you mentioned single family. So let's back up there. Was this single family that you're renting?
Yeah, it was buy and hold. It was a buy and hold, was a single family home, nice, great property. At that time, we didn't know how to underwrite. We didn't know it was even possible to have cash flow. All we thought was, hey, let's put a whole bunch of money into this one property. And then in 30 years, maybe it'll double. And at that point, we'll have this nest egg of, this thing. But then after a while, Nan and I were calculating. We're like, do you know how much money it would take to buy all these houses in LA for us to actually have a comfortable living? And the math just didn't make sense.
Yeah, on top of that, we had no idea what is apartment syndication. We didn't know that,
we didn't know it existed.
We didn't know that ordinary people like us can actually own part of the apartment pie. We thought we need to be ultra high net worth individual, have millions of dollars to invest and own apartments.
And many people, I think our experience was hey, you need to start small. You need to do single family. Maybe we'll one day graduate to duplex, triplex, quadplex. Like Nan said, never in our wildest dreams would we own any apartment of the size that we have now.
Yeah. There's a few things on that. One, scalability that y'all experienced, right? You had the house and you realized you would need quite a bit of these houses to give you that income. And then the other thing I heard too was appreciation versus forced appreciation. So you're hey, I'm gonna buy this house. And this is me too. I started off single family, bought our first house actually in California, but in 29 Palms, so not as fancy as LA. But you know,
I know that area.
I barely made any money on it, but it was right in that 08, 09 crisis. But anyway, the point is that, you buy, you think, oh, my expenses are going to be X and my rent's going to be this, and I'm going to make some money. And then, but the big piece is the equity, like especially in California, the idea is it's going to, but when you look at syndication or apartments, you're pulling your money and then you're buying these apartments. So if you didn't know about syndications, you didn't know about that you could possibly own, these bigger projects, like how did you stumble across it?
That's a good question, Nan. You can answer that one.
Yeah. So you know how we say we start with flipping business, right? And through flipping business, we, learn about apartment syndication. And that's when we start actually investing as a passive investors.
Yeah. So basically, to backtrack a little, once the fashion business crashed, we were like, oh my gosh, we need to do something. We picked real estate. And we didn't know about multifamily at the time. We were like, okay, let's flip houses. We live in LA.
We love like business. We're entrepreneurs.
Fashion, design.
We love business, entrepreneur, and we love real estate. Let's do a business that we can combine both our entrepreneurship and real estate. Yeah. And that was when we like, voila, let's do flipping.
Yeah.
But quickly we realized that flipping is a lot of trading time for money. So why would happen without us, right? Like what we're trying to create. So we would be missing like our family dinners or like our friends' bridal showers because we were still really much involved with trading time for money.
Yeah, and through just going to a lot of RIAs and stuff like that, we started hearing like whispers about multifamily apartments, and we're like, tell us more. What is this thing? What are you talking about? And then we started hearing more and more, oh, people do syndications.
And this is truly passive, where you don't have to, lift a hammer to make cash flow or tax benefit or crazy return.
Yeah, and that's why we're like, okay, solved. Yes, we should have, had we known about this, Wayne, when, prior to our business closing, because of our customer closing all their stores, I think we would have been in a much better predicament. It was just like one of those things where like ignorance isn't bliss. It's actually like a fault. So yeah, so I think at that point we were like, okay, we're in. Let's at least at that time, I don't think we had like aspirations to do it actively. We just kind of like, let's do this at least passively. It's going to be much better for us.
Yes. And I would totally encourage anyone who wants to start the apartment syndication journey, even if you want to be an active investor, you should try to see if you even like this field, right? You should start with like passive investing to see if you even like the apartment syndication, if this is even an asset class that you want to invest and devote your time to do.
Right.
Yeah. I think to myself sometimes, I'm like, so I'm obviously an active investor myself, but I'm like, passives, they have it good, they're investing and they're getting preferred returns, and that's the whole, point is make our investors a lot of money. The goal is they'll reinvest, et cetera, and continue growing their wealth. But for sure, I think the passive, it takes a special person, in my opinion, to enjoy the active side.
Yeah.
And so it's sort of like, it's not
for everyone.
It's not for everyone, for sure. So when did you know along the passive side, like, hey, I'm more of an active person. I like to underwrite and negotiate and find brokers. I mean, that's the things that, the list goes on and on and on. So what excited you about the active side?
Yeah. You know what? I think it comes to the scalability, and because we value our time, we started appreciating, hey, a lot of the underwriting that we were doing for single family, if we scale, there's more nuance obviously to multifamily underwriting, but at its core, it's pretty similar. What are you going to purchase for? What are you going to add to it in order to make sure that you can support the mortgage? And how are you going to be able to increase the property's value? And so from there, we realized, hey, single family is great, but there's tiresome stuff. You have to deal with the contractors who sometimes are reliable and are not reliable. You have to deal with the city who's like especially now during COVID, a lot of people who listen to you probably have experienced delays at the city where they're not issuing permits as quickly as they used to. So those things were stuff that Nan and I decided we don't want to do this. We rather have, if we were able to scale to multifamily, what we learned from the GPs that we invested with was that, hey, there's someone else who can handle that role, even if you're active. And that's where we felt, okay, that's a better business model for us.
Yes. And on to add to what Palm just said, I think as we're becoming more involved with passive investing, we gain confidence. We know what to look for, how to underwrite the deal, what is a good deal, what is a bad deal. And, we learn a lot from apartment operators, like who we, like follow or just invest with, that, hey, this is the way to do the deals, So.
Even like basic communications, communicating with investors, before, after, how does that look like, reporting, all those things. Like it really was, when we passively invest, it was really kind of like we were getting paid to learn this business. And we got to learn it in a safe space where someone else is doing all the hard work and we're just coming along and basically almost like shadowing them. And that's how we make money. So great gig.
So one of the questions I've got for you too, so when you switch over to the active side, so you came to the US early on. Were you citizens at a certain point? And I ask this because I'm curious, there's people maybe listening in on, are there any hurdles for people that are, and I don't know if you're American citizen or not, we can go through it, but are there hurdles in general for people who may not be American citizens buying large multifamily assets?
Oh, so we're U.S. citizens. Our parents came and they applied for us when we were little. So we came, legally. So that part was not a problem. What I think is actually the hurdle, maybe cultural. So as our parents, when we first started getting started, even in real estate, our parents were really against it because in their mind, again, living in California, they're like, it doesn't grow. It doesn't provide any cash. And they rather hoard cash because they think cash is king. It's a kind of like an old world mindset where they think that, hey, if I have more money, I'll feel more comfort.
Or if I have like money in the bank and seeing my account grow, that's how their mindset was. Feel secure.
Yeah, but they didn't know that, hey, there's this thing called inflation that's eating away at the buying power. And they didn't know that there's other things that we can do now that actually accelerate our growth while hedging inflation. So I think it's more like a cultural thing. And to be honest, like Nana and I heard them, and there were some moments of doubts where we thought, is this the right move? But then we felt like, no, you know what our parents, like what any parents know doesn't necessarily mean that they know the right thing. You know what I mean? Like, so they mean well, but they may not have all the actual answer because their mindset is from a very traditional point of view. While we all now know that actually
going to school, get a good grade, get a good job is not the way to, have a nice retirement, right?
Yeah. So I would say that part was something that had our parents been more pro like real estate, maybe we would have started like even earlier, right?
Yeah, it's fantastic, everything you're saying. And also like generational, for example, my parents, they're retired. And, the idea of investing in real estate doesn't really excite them. I'm not saying all generation of my parents' age are like that, but to your point, having that money in the bank and being like, hey, this is my safe egg for my retirement, it's that mindset and the shift for sure. You mentioned inflation a couple of times. And so it's a good shift to one of my questions that I've been thinking about a lot lately. And that's the Fed rate increases. It seems, when with Twitter and everything else and, the Fed's coming out and, nothing's been done yet. Right. But the anticipation of things happening is already adjusting the markets in many ways. And, as of this week, I was looking at a deal and it had a lender quote, and it was the first time in a while that I've seen it over, 4% rate for an agency loan. So it's been a while, but just curious, with the changes in Fed rate potentially, and then we've got these supply challenges, how are you underwriting and viewing deals this year?
Yeah, I love this question because I think it's prudent to pay attention to these things as passive or active investors. And, I subscribe to the mindset that like, hey, as long as the cap rate to the inflation rate is like still pretty substantially different, we're still pretty safe. The other thing is that as people are right now, so many people are jumping into the multifamily game. There's a lot of money. As you know, Wayne, like there's a lot of money coming to multifamily. I don't foresee the cap rate increasing in the strong markets anytime soon. And so while we have to be prudent, and I think like the simplest thing is as always, we always underwrite about 50 basis point above whatever term sheet we get from mortgage brokers or any lender. So I think do at least that, and also like put in some like other conservative things here and there to make sure. As far as supply challenges, we have some, right? Like right now, there's some cabinet shortages from our apartment in Atlanta. So my solution was I told them, hey, look, there's so many of cabinet wholesalers that we know in LA that are like direct from factory. Why don't you give us your specs? We're going to shop it for you. And then if necessary, we can have them shipped directly across the country instead of waiting 4 weeks to have it ready. And so then like, your apartment is sitting there vacant. And so some stuff like that where we can help because
proactively thinking.
Yeah, kind of outside the box because LA is a major hub for a lot of construction stuff from the world and especially from China. And so we have a lot of access to those things that may not be available in Atlanta.
And I think due to our like flipping backgrounds, we actually have
a lot of sources for vendors for stuff.
Yes.
Yeah, that's great. Yeah, you got those relationships. And like you said, LA is, it's all sort of the heartbeat of where everything is coming in from a supply standpoint. So going back a little bit, you had mentioned when you see cap rates and interest rates having that gap, then but I'm seeing, at least in the Texas markets where, we're at a 3 cap, 2 cap in some parts of Austin. Yeah. It's insane. And I absolutely agree with you on the multifamily side. I'm a multifamily investor, but at some point the water is bloody. There are so many sharks looking after the same things and then, reprocessing the same meat, it's getting ridiculous. So, so when you start seeing that interest rates and that cap rates, do you steer away from those markets and then start looking for markets, tertiary markets in other areas, maybe other states? Do you start shifting?
We are expanding outside of the Dallas area, Fort Worth area, Texas area to like Atlanta, Georgia, for example. But I think, there's other variables that we have to consider beyond just sheer cap rate. So affordability, are there net migration? Is there a housing supply shortage in the area? Are there an increase in good paying job coming into the area? Because while the cap rate may be compressed and we're buying it at a 3, I haven't bought anything sub 3, but let's say a 3 cap. When we're underwriting, will we be able to support our pro forma rents based on our purchase price and like would it cash flow? So all those things are also a consideration. So it's not just like, hey, so basically the cap rate itself doesn't tell the whole picture. And so therefore we also consider other things to make sure that the deal actually pencils out. And a lot of time that has to do with like doing a lot of different stress tests on the property as well, just to make sure, hey, worst case scenario, if we have to exit at a higher cap rate, what would it look like? And we, of course, rely on a lot of the industry data, CoStar, Yardi, to kind of give us guidance on what the cap rate would be on the exit in 3 to 5 years. And then we always pencil in something above that. And so, for example, even if we're buying at a 3 cap and they're saying, hey, in 2 years, we project it's going to be 4, we're going to put 4.5, something like that. That gives you a bit of cushion. So if we're wrong and it's under that, everyone's going to be really, really happy. And if we don't hit it, but if it goes up beyond that, if it goes to 4.5, then we're still safe. And even if we go a little bit above that, because normally our returns are 100%. So even if we go a little bit above 4.5, then we're still safe. They're still going to make a great return, So there's like I said, cap rate is one thing, but there's other variables as well that we consider when we're looking to purchase a property.
Yeah, I think it's well said. I think the big point is that you got to think big picture. You mentioned the migration, and especially in the Southeast, and even outside Texas. You mentioned Georgia. You're investing in Florida. We recently did a project in Louisiana, and these states, the jobs are coming, and people are moving for many different reasons, but definitely a huge piece. So supply and demand being one. You had mentioned when you underwrite, and I think this is a great point for those that are, underwriting deals, is the markets are changing so fast with the interest rates that putting in, 50 basis points higher than the loan quote, I think is a fantastic idea. Because think about, you're not going to be able to close on the property in many cases, 30, 45, up to, probably 60 days and
even longer, right? Maybe 75.
Or longer, depending on, the backlog with agency, Fannie, Freddie, et cetera. So yeah, that's huge. Putting that in a little higher. And that's a big takeaway for me, because I've been putting in really the rates from the lender, but you make an excellent point that you really got to put it in a little higher.
Yeah, I would definitely go higher. And again, those are all the things that if it doesn't, we close and it ends up being whatever they projected on the term sheet, awesome. We made money. We made even more money, right? But if not, then we're at least like, okay, like for example, right now we're closing 8 days from now. And obviously the rate caps are going up. And the question is like, wow, it's like, it went up from probably in September, I think it was like $80,000. Now it's like $300,000. But can we afford it? Luckily, our underwriting already was, our closing cost was higher than what we thought at the time. And so it covered it, and so things like that really saved our skins, because we're like, okay, we can afford and not have to put more into the closing costs. And that comes with, just having the experience and being very like conservative about the approach to underwriting.
Yes. And I think that's what passive investors need to really focus on. You don't want to invest in a deal that's somebody's first deal, right? You want to see their track record, their experience, and, like even if they have any deals that gone full cycle or not.
Yeah, I agree. I mean, it's a team sport. So those that are, on the team that are executing the deal, for sure, look and analyze. And I think a big point on the passive investor side is really understand what the debt structure looks like. On a previous podcast, we talked about the bridge loans and how I'm seeing in these active sponsors, and I'll use bridge loans to buy properties because they don't meet the minimum debt service coverage ratio. So in essence, they're overpaying. If there's not a true value add story of, you're going in and you're truly renovating deep and you're pushing rents, but you're pushing rents to the market instead of you already being at market. So all really great points. I'm really focused on still agency debt. In today's market, most people are not going after that. But my biggest concern with bridge is, you can get 3-5 years IO, but if you need to refinance, or if you have to refinance and your DSCR is not at that minimum 1.25, you're pretty screwed. You can kick another year or two potentially on your deal, but there's just a lot of risk for that. And I like that you're capping your rate, even if you're spending more. And so Definitely. That's a huge thing for listeners to consider. Because if there's a variable rate, I mean, remember what happened in 07, 08?
Yeah, when, exactly.
In these jumbo loans all became due. So I mean, it's just a huge aspect in investing is the debt piece.
Yeah, and you have to balance it, because we know of a lot of people who just jumped into like long-term fixed debt, agency debt, and now they have such large like yield maintenance that they can't exit the deal. And so you want to have that flexibility, but you also want to have like insurance on how much the rate increase can get to, so that your investment is, and is protected. Like, we're not expecting 10% interest rate, but hey, they're talking now about maybe 50 basis point increase in March. So that's a huge amount, like in one go, if they're gonna keep push it up that high, like what will be the next time? Because they're projecting maybe 4 raises in interest rate this year. And so what would that be? Would that be 2%? Like, I don't know what it'd be. So at least we need to protect our investors for any of that kind of like as much as possible,
Yeah. I mean, it's the crystal ball of what's rates going to be doing in a couple of years, because if rates are going up, which sounds like y'all agree that they're going up, I believe they're going up, then the prepayment penalty is going to be a lot less. I mean, I'm already seeing in the markets where deals that a year ago sellers wouldn't even look at selling because they were going to get hit huge by a prepayment. Now I'm getting calls and saying, hey, you reached out to me last year. I mean, literally I had a text message this week from a seller in Houston that's like, hey, it may make sense to look at selling. Now they still want a high price because everybody wants a high price in Texas, but we can work through that, but at least I'm not having to have the hurdle as much with the prepayment. And then I'm also liking the step down, the ready step down. So you pay a little higher interest rate, but then you have that, was it 5, 5, 4, 3, 2, 1 penalty. Right. So but all great points, because at the end of the day, like debt can make or break deals, and it's And it's got to be part of the strategy that, either a passive and obviously an active investor's got to look at.
Yeah. And if I can add one more point to this, like with us right now, we, as like part of our company investment like ethos, we like to turn properties quickly. And so having like a variable loan term, it allows us to be able to exit deals faster. So 18 months after that is a 1% prepayment penalty. That's great. So like there's deals right now that we're in that we're projecting, hey, we're going to hold it and we're going to sell it within like once we hit that kind of threshold.
Yeah. But then you're also paying a cap. So you're mitigating your risk, right? On that.
Right. Exactly. Yeah. Yeah. And two of the deals that we've gone full cycle,
Our average is like around 23 months.
Yeah.
So relatively really quick.
Well, and that goes into passive investors. That's what we're seeing a lot, right? Is these deals that are, that were supposed to be a 5 or 6 year, maybe not in your case, because you had a short-term horizon on your deals, but in a lot of cases, 5 to 6, 5 to 7 years, but the numbers are making it so that way, hey, 18 months, 2 years, the markets are the way they're churning. But what's happening is these passive investors are getting this wealth event. And then they're having to look at, redeploying that, pretty quickly when they were basing it off cash flow. Like they were thinking, hey, I'm going to get 10%, and well, that's a little too high right now in the market, but say 7 or 8%, returns year over year. And I'm, that's going to help for whatever, passive income lifestyle you have. And then, now they're coming in. Now the equity is nice, but as passive investors that are listening in, that's a big piece of knowing like, hey, is this a cash flow deal? Is it equity or both? Or is it, if I have an equity event in a couple of years, am I going to be happy with that? Because there's definitely investors out there who are long-term, do not sell, they're active investors. And I'm meeting more and more of those where it's just like, hey, we're buying and holding. And it's all about the cash flow. And so
it's like you have to be able to find the right investor for the right deals. Like you said, there's me investors who are kind of like, hey, what is it called? Mailbox check people, where they just want like, hey, I want my predictable cash flow month after month and just don't tell me about anything else. I don't want to sign even another subscription document. But there's others who are in the kind of wealth accumulation phase. And that's most of our investors, I believe. And they want to keep redeploying their money so it keeps doubling. So like we did a 27 months hold, 2.85x multiple. Now, if someone who invested 100K, now their equity is substantially increased, right? So therefore, instead of like, hey, 8%. Instead of 8%, now they got cash flow the whole time plus equity. And now they're like, hey, I'm going to redeploy a large portion of it, but I'm going to hold some back to spend as if it was their cash flow. And so it's kind of like potentially winning at, like getting both sides, like getting both the benefit of cash flow doing the whole, but like you're going to get this massive capital gain that came your way just for investing in a few months.
Yeah, I agree. And I think, for some of the deals that we've pitched out there to our investors, it's like, hey, the best case scenario is, we may have like a 2 to 3 year hold, but, be happy with 5 to 7 years, because real estate can change obviously based on the economy, what's going on with markets, et cetera. And so we've been really on this wave of, this returns and all, and in pent up demand due to COVID and supply demand. And then a lot of people are starting to get into, this field, et cetera. So it's this perfect storm. But I always tell investors, if you're happy with the 5 to 7 year hold, then you're going to be extremely happy with a 2 or 3 year hold. To your point, if you're, making that big of a return. So it's realizing that real estate is cyclical and it's not always perfect, right? And plans deviated, but it's just part of growing wealth and that risk standpoint. There's risk and all. So,
and I think like that's like, I mean, of course, COVID. That's kind of like the unknown that no one would have seen. And so you're absolutely right. It's like in anything, like I'm sure every investor understands is like any investment comes with risks. And then like what will mitigate it is being educated, investing in deals that have conservative underwriting and have some safeguard for some events. We can't predict and know everything, but we can try our best to mitigate the known factors.
I wasn't planning on going this direction, but I feel like it's such a great topic about risk mitigations. We talk a lot about underwriting and looking at deal sponsors and all to reduce risk. And those are important things. But, simple, just go into the flood map, go into FEMA's website and just putting in the address and seeing if this property that you're passively or actively investing in is in a flood zone or a bayou in certain parts of the country. It's worth that Google search or that FEMA, search. Multifamily, these real estates are already have some there's already some risk, right? And some more than others, depending on if it's a development or full rehab, et cetera. But why go into, this is my risk profile. This is not perfect for everybody, but why go into a deal that already has a little higher risk because of it being in that flood zone? I don't know.
I mean, like in general, like hairy deals, like don't bring it our way. Even as passive, we continue to passive invest and we'll pass. It's like we like good returns, but we're okay with we're happy and like very, very happy with the returns that we can get now. And we don't seek outrageous things that are on hairy deals.
Well, just, doing a Google search of the city. I was recently doing it, looking at a deal. And when I Googled the city, and I won't say what it was or what city, but it came out as one of the first, top 2 or 3 Google things that came up was the city is 98% more likely to be hit by a tornado than any other US market.
Oh, wow. Can you tell me that offline?
Yeah. And I'm like, wow. Even though this property has been around for a very long time, I'm like, it's still a risk. Like, we have risk in, a building goes down with fire or something, and obviously it can be rebuilt, but during that time you're losing cash flow, right? There's not a business income replacement on that. And so that's there's just those risks, but I mean, just can't state enough, just do your own due diligence, of researching the property, maybe even going to the property if it's near you. Any other, while we're talking about risk mitigations, anything else you do from a passive and active investor side when you look at deals?
Yeah, I think like a lot of times, like we'll kind of like underwrite for worst case scenarios. And that practice started with COVID, just making sure that our portfolio was going to, at the beginning of COVID, no one knew if people would start paying rents. People were just stocking on toilet papers and like all
canned food.
Canned food. And so we're like, are there gonna be riots? I mean, this is me being like apocalyptic at the time. Like, are there gonna be riots? Should I buy a gun? Like, I went pretty dark for a moment there. And so it's like, no one knew. And so like at that time, we started stressing, hey, we need to test for worst case scenarios. And most of the time, our worst case scenarios are substantially worse than historical levels. And that gives us a better peace of mind. And we always elaborate that to our passive investors. And it goes back to your DSCR thing. We always try to see like, hey, will we still cash flow if this happens? Will we still cash flow if this happens? And so those are some of the kind of like backstop that we try to put in place to make sure like we're not super aggressive on deal and it becomes risky. Like I know a lot of people now, they're buying their ingoing cap rate and exit are the same, because apparently there's a consensus that cap rate will not be going up in any time soon. But that for us is still very risky, because what happens if it does go up? So stuff like that, like always underwrite, like I said before, like interest rates always at least 50 basis point higher than what was quoted. Even exit cap rate at least 50 basis point, if you can 100 basis point. And doing some stress tests to see like, hey, what happens if my expenses increase? What happens if my economic vacancy increases? And you can obviously do this as a passive or an active. Check it out and see like, hey, just drop it as much as you can and see like, would a deal still make sense? And then compare it to historical levels. Like in DFW during 2008, the economic vacancy, how much it dropped, for example, and compare it, say, okay, if it drops to this level, what will the financial situation look like? Will it still at least at minimum, hey, wealth preservation is key. So will at least I still own this building? I can support the expenses. I can pay my mortgage. I may not cash flow with this really scary scenario where like worst case scenario, but at least I still own the building, and then we can survive that wave. Because we've seen, we went back to 2001, we went back to 2008, and then we studied obviously COVID this pandemic. And we've seen that multifamily amongst all asset classes drop the least during economic downturn and rebound the quickest. And we see that specifically true in the Sun Belt, where frankly we raised our rents throughout the entire throughout COVID. We still are. And so that part didn't actually impact it at all. And so yeah, I would say like be very mindful of testing against worst case scenarios. And then, like you said, I think it's a great point. Check out if you can, check out the property, check out news of the property surrounding areas, what's happening. So you have an idea for reviews. Because for us, we don't mind bad reviews as actives because we know that we're going to take over and then we can kind of understand what the sellers did wrong and then see if those are things that we have the skill to improve upon. And then we know like, okay, these are the things that they've done really poorly and we're very good at fixing this. So it's gonna be easy to turn to fix those things, stuff like that.
Yeah, that's all great information. And obviously you're very bullish on multifamily. Are there any other asset classes that y'all have looked to diversify in, or y'all just all in on multifamily right now and in foreseeable future?
Yeah, so we love that question. And I guess I want to answer with this quote from Warren Buffett. Diversification preserves wealth, but the concentration builds wealth.
Yeah. So for depending on your season of investing, the answer will be different. For us, we want to diversify as far as geographical location in multifamily. So we'll continue to invest across the Sun Belt, passively and actively, because we are still in the wealth creation phase. Where other people, if their horizon is like closer to like satisfaction of where their wealth is and they're in a wealth preservation mode, they may say like, hey, let me put some money in something. I don't know what would be safer. Gold. I don't know. Bond. I'm not even sure if bond is really that safe, but let's say gold or something. Definitely not NFTs, probably not cryptos, but basically like, so for us, we don't see diversification as a helpful strategy for us.
At least in our season of life right now.
Right.
Yeah. Well, you're focused lasered in on the Sun Belt markets and a particular asset class is doing really well for your investors. So completely makes sense. I've seen people sometimes diversifying in industrial or storage as well, since those are pretty hot.
Yeah, I think they're great. Too. I think they're just great. It's just like a matter of time and time
getting
of learning.
The knowledge
to learn
and our bandwidth.
So at this point, we don't have the capacity, but those are all really great asset classes.
And, I think a good tip would be like before we start to, even move into storage, we probably read up or even do a couple passive deals to see how it goes, right? Put our money where,
put our money in to test it.
Yeah.
Well, I always ask a question at the end about your proudest moment in real estate. But before I do, is there anything else that you would like to share tidbits before we go into the last question and then closing?
Yeah, I think Nan, do you give a tip? I have one too.
Yeah, I think like Palm kind of said it at the beginning that when we first started out our, investing journey, we thought that we had to do everything like small or do everything ourselves. We had that like control kind of issue. But now that we kind of, expand our horizon and getting knowledge and, be really entrenched with this investment opportunity, apartments, we realized that learning to leverage people is the key to, growing.
Yeah, to grow faster. And I think the other thing that I think Nan was alluding to is go faster. And in this business, it's all about connecting with people. Like Wayne, you said it, it's a team sport. Don't think that you need to know everything before you get started. For us, we wish we started or even earlier. And I think most people who are successful would say the same. So don't hesitate, get some knowledge, find the right partners and go get the deal.
Yeah. Yes. Fantastic advice. And so and I'll ask you both, would love to know what your proudest moment in investing in real estate has been.
Okay. So this one, like literally, I don't know, like you guys may be able to tell from our voice that we're actually smiling. So when the proudest moment is when we're able to fulfill our promise to our investors, when the deal goes full cycle, because we talk a lot. We say, hey, throughout the whole, this is what we're doing. We're doing well.
This is a cash flow. We're hitting projection.
This is the NOI. This is what's happening. These are the great things. But none of those are really tangible until they see the big chunk of money hit their bank account. And our joy is really when the money lands in their bank account and all the text and communication we get and like how much excitement that they have from it. And it feels like we fulfilled a promise. We exceeded the promise, and we definitely protected and preserved their money.
Yes, and we have like recently have been fortunate to do not like couple exit that we're able to exceed the projected return in a really short period of time.
Yeah. So that our proudest moment is just getting our investors the return that they deserve.
Yeah. It's a great feeling when they invest in you and you have that fiduciary responsibility to, return as much as you can to them. And then when it happens, to your point, it's fantastic. So love both of your proudest moments there. Anything else you'd like to share on the show or about your company? How can listeners find you?
Yeah, so I guess we want to talk about the important against of having your squad, your people. You asked us, hey, how if you were to, passive investor to get started, like how do they know who to trust or who to invest with, right? So really, we want to stress the importance of know, like, and trust factor, and that would you even drink wine or share like a charcuterie board with them? Passive investor benefit from strong team with proven track record to at least, hit the projected return, if not exceed it.
Yeah. So that's like the important part. And I think like numbers are great, but beyond number, especially when you get this as an asset manager and the property, a lot of people, they're mistaken. They say like you make money when you buy. We think you make money when you buy the right property in the right location at the right price. But more importantly, when you operate it superiorly, that's where the money is made.
Yes.
If you buy two groups can buy the identical property. One will do really, really well, and the other one may not because they don't know how to operate. And the 2000s will leave you with this: like, is definitely the time of operations. Like you have 2020
decade,
the decade of operations.
Yeah, I agree. I always think it's easier to buy the property, and then day one, it's really that's when it counts, right? And that experience and those full cycle people moving forward. So Palmy and Nancy, how can listeners find you? What's your website and how can they reach out to you?
Yes. Well, guys, we hope you learn a thing or two from us and enjoy our conversation. You can check us out on Instagram at the Kitti Sisters and our podcast, Cash Flow Multipliers Podcast. Plus, check out some cool freebies on our website, Apartment Syndication Survival Guide. Our website is thekittysisters.com.
And Kitti is with an I, so the KITTIS. Let me spell that again to make sure I did right. The Kitti Sisters, the KITTISISTERS.com.
Yeah, and we'll put that in our show notes. And please check out that website. It is fantastic. I gave y'all kudos for that earlier before the show, but I was like, that's a nice website. So, hey, Kitti Sisters, thank you for being on the show. I learned a lot and look forward to continuing building the relationship and getting to know each other. Appreciate it.
Yeah,
thank you so much for having us. We, have a blast.
It was really fun.
That's all for this episode. We hope you subscribe, share, and leave a review of the show. For more information about passively investing in multifamily apartments, check out Wayne's free ebook by going to CREIPartners.com/ebook. Also, follow us on Facebook by searching CREI Partners. This was the Untold